Good afternoon, everyone. My name is Kelly Richardson, and I am the CCIM president for the Washington State chapter for 2021. I want to welcome everyone to the May webinar, and we've got a great panel today talking about the different asset classes. We're lucky enough to have our former past president, Fred McConkey, who will be being a moderator today. So thank you, Fred, for volunteering to help us out. I would like to thank our annual sponsors for CCIM Washington State, the Benaroya Company, Lisa Goodman and Larry Benaroya, Office Space Industrial. Please visit their website for more information on the assets that they have available for lease, as well as additional information. I want to thank also Kevin O'Keefe with Ameriprise Financial. Kevin does a great job in helping you to diversify your assets. Please check out Kevin O'Keefe. Also, Rob Sargent with Sargent Legal. He is a longtime real estate attorney and has all knowledge about all things real estate, whether it's investment or leasing. If you have questions, real estate wise or contract wise, please contact Rob. Thank you to Stewart Title, Kelsey Azur. Please see Stewart Title for all of your title needs. We're thrilled to have them as a sponsor. We also have our annual sponsors as well. IBA, Kurt Meyer, Mergers and Acquisitions. Triple J Properties. They are a new sponsor and they're a real estate syndicate. They're actively seeking well-located value adds or core small to medium-sized medical or dental buildings in the state of Washington. So if you have those available, please contact Triple J. They're also open to investors. BII, they're an interior design firm. They're utilizing space planning and they have partnerships with quality office furniture manufacturers to assist in creating functional, comfortable, and attractive environments for all business types. Bank of America, Lee Wang. We're lucky enough to have Lee on our board. Thank you, Lee. McConkey Development, Fred McConkey, and myself, Kelly Richardson with Rowley Properties. Dirtfish, Molly. So Dirtfish is a rally car racing school, and they're the only rally car racing school in the Western United States. They're out in Snoqualmie, and it's an amazing place to visit. So please check them out. They teach you all about how to drive in unusual types of conditions. Blue Ink, Chris, he's a real estate brokerage in Bellingham, so does both commercial and residential. Please check out Blue Ink. Great Earth Realty, Larry Yu. They specialize in retail and restaurants, whether it's investment or leasing. Please check out all of our sponsors. You can find more information on our website at CCIM-WA.com. I'd like to thank our media partner sponsor, the Daily Journal of Commerce, and our in-kind sponsor, BDP Design, Kelly Beckley, All Things Marketing. Thank you so much to all of our sponsors. Now, our upcoming events, again, you can check out on our website, CCIM-WA.com. We have our weekly real estate consultation clinic. This is a free clinic. This happens on Wednesdays from 4:30 to 5:30 p.m. It's an opportunity to talk to experts in the field. And you can see some of the topics here. And today's topic is office. Devin Meekum. We're thrilled to have Devin. Then if you go to our website, you'll see all different types of topics, whether it's development, retail, etc. So we want to provide this value add, and it's a great opportunity to connect as well. Now we are planning, we have a new course that we are offering on Tuesday, May 18th, and this is our Site to Do Business course. We're going to be having a training from 9 a.m. to 11 a.m. This is getting you so that you're skilled in this use for the advanced toolkit for your business. And you can do integrated mapping. There's just a lot of information, and it's continually evolving with the Site to Do Business. This This class is offered only for $25 for chapter members and then $45 for new members. So please register because it is filling up. See our website for more details, CCIM-WA.com. Now, next month, we will be having a program which will be on June 8th. And we're lucky enough to have Rob Sargent as our main speaker, and he will be talking about how brokers can utilize escrow and title to help their business and to add value to their business. So this is something you do not want to miss. It is free, and he's actually taught classes on this subject in the past. He's an expert in this. And that will be, save the date, June 9th from noon to 1 o'clock. And then check out our website calendar for updates on classes and events. We are moving forward with classes that will start as early as August with 101 and going into commercial real estate negotiations. We are planning in-person classes, so we hope to see everyone there. Please check out our website again for more information. And there are scholarships available as well. So if you are looking or needing to take the core classes for CCIM, check out our scholarships. Those are available for our in-person classes. There's information on our website about these scholarships. And please contact Amy with SEBA because we'd love to tell you more about it, more of the information. And there are a number of scholarships that are available in the fall for our in-person classes. And visit our website, CCIM-WA.com, for more information. All right. With that, there is a market update on May 18th as well. This is an online workshop from 3 to 4 p.m. and talking about real estate investment. So we're going to hear quite a bit about that today, but there's another opportunity for you to get more information as well on May 18th. I'd like to go over a little bit of housekeeping details. Please submit your questions in the Q&A forum, not the chat window. So again, use the Q&A forum. We're going to be able to upvote questions, and upvoting will help Fred prioritize the questions that he's going to be asking. If you're having difficulty with Zoom, then try logging out of the webinar and logging back in. And finally, we are recording this webinar, and it will be available on demand on our website at CCIM-WA.com. With that, I'd like to bring our panelists and Fred up to the screen. Thank you so much, Fred, for agreeing to moderate today, and I'm looking forward to hearing all the things that our panelists have to say.
Great, thank you very much, Kelly, appreciate that. So what we're doing today is we're discussing the 4 different types of real estate, being office, retail, industrial, and multifamily. And it's been a very different, unprecedented year. And we're just going to talk about what is happening in that asset class. So I think I'll start off with Candice and ask you, how is your real estate class, being multifamily, impacted by the pandemic? And then along the same lines, did government programs or actions taken, did they help or hurt your asset class of apartments?
Well, hello, nice to see everyone. Let's see, so the first question was, how was our asset class impacted? And I would say the answer is incredibly, and I'm sure that's the case for all of the product types from what I've heard over the last year. I liken kind of the transition into 2020 like someone was just pouring a bucket of water over the heads of housing providers, but it was just an endless bucket of news and information. I mean, we had a public health crisis, we had a social justice crisis, we had an environmental crisis, we had a very bitter political crisis. So if you think back during that time, you think back of like March as things were really unraveling, there were so many elements to what was happening. And it wasn't just multifamily, it was everything. And so, you know, that was incredibly impactful. We saw in 2020 a huge dive in average volume, deal volume, which was concerning. And I have some good news on that for later. But in terms of the government programs, you know, obviously there was very quick action as it related to unemployment support and rental assistance that was really useful. The big message early on for multifamily was really about helping tenants pay their rent so the rest of the chain would stay intact, right? We don't need landlords not able to make their mortgage payments and then banks not being able to, you know, lose their credit ratings because they're trying to work out payment arrangements with their customers. So there was this kind of worry about this trickle up effect. And, you know, in a large part, our region was able to kind of keep stable on that topic. So the unemployment support and rental assistance were sort of the key components that were helpful. I would say hurtful were really a lot of eviction ban and rent increase caps, both on multifamily, but also in the commercial space. And that's created sort of this alternate reality where how do we get out of this alternative reality? And that's been the biggest challenge for investors. We can talk more about that, but you know, how do we get off the on-ramp as it relates to these kind of artificial policies?
Great, thank you, Candice. So Kelly, we'll ask you the same question. How was office impacted by the pandemic, and did government programs help or hurt your business?
Well, office was significantly affected by the pandemic. Remote work policies were immediately implemented. Companies like Amazon, Facebook, Google have mandated work from home policies until at least through 2021. Now, Facebook is adopting a work from home policy until July of this year and has plans to transition as much as half of its workers permanently to working from home within the next 5 to 10 years. Google has said, well, we'll let our employees work from home until September of this year. But the company has let employees know that they're going to be having them work from home for 2 days during the week after that. And I think that's kind of going to be a typical model that you're going to be seeing coming out of this. Now, Microsoft has revisited its work from home policy to focus on flexibility, giving employees the option to explore different remote work options, including work hours and even geographic location. So the pandemic has really upended office. Now, tenants in downtown Seattle, well, they are paying rent. They're not occupying it. So downtown Seattle has really been hit the hardest. With occupancy to be about 5% in the high rises. Bellevue CBD is better. They're around 10 to 20%. Tertiary markets, we can see upwards of 25%, and it's climbing. So now investment volume did slow down significantly during the pandemic with office. But you'd think that prices would be affected, and they weren't at all. So high-class 4- and 5-star properties have been, I'll talk a little bit about that later, but it's been, they have not been affected with regards to value. Now, also companies are implementing the temperature checks, social distancing, of course, signage. In addition, putting in those MERV 13 filters and higher rated filters are key so that you can have that quality of air. And then some buildings have moved forward with touchless entries. And so you're going to see now with the vaccine rollout, you're seeing things changing at a very fast pace. Employees are wanting to come back to the office. It's a matter of how. And what does that look like? So some of the big tech firms are announcing that they're going to be bringing have announced that they're going to be bringing employees back by at least the end of the summer. Microsoft has stated that it has around 20% of its global workforces in offices at least some of the time. And so these big tech firms, while they led the remote working, they're also going to be leading coming back into the office. So it's going to be really interesting to see how that shapes up. And then as far as governments and how that helped or hurt the asset class, well, the PPP loans helped businesses significantly. That was a great thing to see roll out and be able to at least adapt during this changing and wild time. That covered PPP loans covered rent as well as labor and operating costs. And what didn't help is the city of Seattle, the Seattle Council in 2021 passed a payroll tax for companies with 7 million or more in annual salary. And they're going to tax payroll salaries of at least 150,000 or more starting as early as 2021. This is a stepped tax, and some of the affected corporations, of course, are going to be Amazon, Nordstrom, Starbucks, among others. And then with all of this and some of the other challenges with Seattle, you are seeing the East Side as a beneficiary to what's been happening with some of these challenges.
Thank you very much, Kelly. Larry will ask you the same question. How were retail and restaurants impacted by the pandemic?
Yeah, good afternoon, everyone. So retail and restaurants were impacted really, really hard during the shutdown as a result of the pandemic. Few people actually saw it coming, and most of the industry, we were actually caught unprepared. So almost everyone went into a survival mode. Now, COVID is an accelerator. So what we see is a lot of weaker retailers leaving the scene. At the same time, we are seeing stronger retailers using this as an opportunity to expand. And also retailers who adapt and reinvent themselves also tend to do better than retailers who continue to use their existing business models. So the second question, did the government programs help or hurt the asset class? The PPP and the EIDL and the state grants are the lifeline that help many retailers and restaurants tide through one of the most difficult period of their existence. Without the PPP and EIDL, we will see many more retailers actually go out of business. At the same time, the unemployment benefits given out to help the workers are actually hurting the industry. So as retailers reopen and return to normal, they are finding it very, very difficult to rehire workers to come back to work. At the same time, while we are talking about government programs, we are seeing a trend where emerging trend where buyers are now requesting to buy entities. They are requesting to buy the legal entities along with the properties as well as the business that they're buying. So this is very interesting because when they buy the entities and maybe they can apply for the PPP as well as they buy the entities along with the properties and the businesses, lock, stock, and barrel together with all the liabilities. So this is very interesting trend. However, it is also adding a new level of difficulties to the transaction, because right now we are not only evaluating the properties and the business, is adding an extra layer of due diligence in the evaluation of the entities.
Oh, didn't know about that. Thank you, Larry. Matt, same question for you. So how was industrial affected by the pandemic, and did government programs help or hurt?
Hi, Fred. Thanks for having me. I would say I'll try to keep this short and sweet because I think everyone before me hit the nail on the head, but industrial has kind of been the darling of the pandemic, I would say. Certainly affected, like many, when everything first started going down last March. I was looking back at some notes, and I would argue that we initially had probably about a 60 to 90-day pause starting in March where everyone, I think in the entire world, just didn't know what to do for a minute. And then industrial very quickly pivoted and figured out how to keep the lights on. And I think the real reason behind that is the industrial sector services just about every other sector in some way, shape, or form. And also just, I mean, you could call it the world in general. And if you look at from the government program standpoint, PPP was huge for industrial users. Also from government regulation, so many industrial users were deemed essential businesses pretty much day one. So while there were policies and things put in place that maybe limited how industrial users conducted their business from safety standpoints, most of them were able to stay open in some way, shape, or form and either keep employees on through PPP or just bring employees back to the, the office, the warehouses, and facilities for manufacturing in general, just through safer measures. So the whole industry as a whole pivoted pretty quick there. Heading into the latter half of 2020, things started to accelerate. I mean, if you were looking at industrial pre-pandemic, we had our foot on the gas and had it on pretty hard, arguably so. If you could probably say we were going 60 and a 50 and then hit the pause button there for that brief period, foot back on the gas, and then heading into the end of last year, I mean, it's foot to the floor as far as the gas pedal goes. I mean, you look at just about every measured metric on the industrial sector, vacancy rate, rental rates, absorption, capital markets spending. I mean, everything Q4 and Q1 of this year has been astounding. And I think it really comes down to the fundamentals of the market weren't broken pre-pandemic, and the fundamentals are still so very strong. It's simply put, just everyone has had to pivot to adjust to what's going on in the world. And frankly, the biggest thing, as everyone knows, this isn't news, we've been talking about for years, is e-commerce. I mean, e-commerce is such a driver in the industrial sector. And the pandemic only forced more and more people to figure out how to order goods online, and consequently are driving business to the warehouses. Users who service e-commerce clients are getting bigger. They're leasing more space. They can lease it at a higher cost because commodity costs and goods costs are going up, and those are getting passed back to the consumers. So all things considered, things are moving very quick in this world, specifically here in Washington as well, with the two ports that service our market. And I mean, everyone else too has also seen how congested the ports are down in LA and Long Beach. And so we're even seeing more of that traffic come up here to the Northwest. So, I mean, it's kind of been, it feels too good to be true. And I feel fortunate. I think a lot of industrial users do too. So we'll see. It seems like it's going to continue here for the short and possibly the long term.
Great, thank you, Matt. I think we'll continue with you on industrial. What did buyers and sellers do over the last 16 months? And then what do you see happening now and in the future?
Buyers and sellers definitely got scared last March. I mean, everyone sat on, especially from an institutional standpoint, which when you look at the Washington market is the majority of our transactions. And every institution immediately put the halt on any deals they were working on, any purchases, sales. I mean, the capital markets dried up for probably about 4 to 6 months there. And then I think everyone started to figure out that there was a way out of this, a pivot, and a way to still place money. And there's still so much institutional money in every sector that still wants to get placed out there right now. And everyone saw very quickly that industrial was already an attractive investment vehicle and only got more attractive through this pandemic. So if you look at Q4 and Q1 transaction volume, I mean, there's been a lot of money being placed here in the market for the transactions that can happen. I mean, we still have an inventory shortage, so that's a problem. If you're looking more from the sale side, a lot of sellers who have been sitting on the sidelines for a very long time, just collecting rent and happy with it, are starting to consider selling. A couple reasons for that. Number one is some are afraid of missing the market. Although things are still pretty good right now, I think there's still a lot of doom and gloom on the horizon that people think may be coming. So people are wanting to sell and take advantage of this record pricing that we're seeing today. And then really the big other thing is changes in legislation. So I mean, we're talking about increase in capital gains, removal of 1031. That has a lot of sellers scared that they're going to miss the boat on those metrics as well. So it's freeing up some inventory. I mean, we still have such an inventory shortage that it doesn't feel like it necessarily. But if you look at it at the nitty gritty, I mean, we're seeing some changes out there.
Thank you, Matt. Say, Larry, how were restaurants and retail impacted in terms of buying and selling over the last few months, and then what do you see in the future here?
There was a period of panic in the second quarter of 2020, somewhere March to June of last year. Everyone was really, really uncertain what hit us and how do we respond to the unfolding crisis. So transactions largely came to a halt between March and June of last year. In the third and fourth quarter of 2020, except for a short period somewhere around October or November of last year. So retailers and restaurants, essentially they evolve into survival mode. They adapt to the government regulations, the shutdown and the gradual reopening. And we're beginning to see an upward trend in the third and fourth quarter of last year. The first quarter of this year was very encouraging as we see light at the end of the tunnel with the vaccine. And so we're pretty much preparing to return to a new kind of normal. So the clients that there's actually two categories of clients that we are seeing in the retail sector. First, clients with an unsustainable business model, and COVID is an accelerator. So they actually COVID become an accelerator of their demise. They actually leave the scene. You know, they give the leases back to the landlord or give the key back to the landlord and say, that's it, I can't take this anymore. And second category, we have clients with very strong business models, and they are actually expanding. And we actually help quite a few of our clients who come using this as an opportunity to expand. And we actually do a lot of leases during this time, not so much of sales, a lot of leases. Even though we have a couple of user operators under sales contract. In terms of investors, we have investors coming in who wanted to buy, but the expectation gap between the buyer and seller is still pretty big. The buyers are still looking for discount, but some of these healthy sellers, they are pretty much holding out. So last year we had a lot more leases.
So Larry, what did the international group, what did the international buyers, did they stop or what did they do?
Well, the China market is pretty much, institution-wise, is pretty much dried up. So it's not only just the pandemic. You know, there was hiccup in relations between the US and China. So what we're seeing is actually Korea emerging as the biggest investor into the inbound investment into the US. And in the last couple of months, we're actually seeing, or last couple of weeks actually, we are seeing some of this Korea, even in Taiwan, we are seeing them getting hit with this COVID-19, new variants of this COVID-19, just as we are recovering. In markets like Taiwan, they do not have the vaccine. So, and they have been pretty effective in keeping very tight control. But somehow the virus still got through. So right now, from what I'm hearing, they are seeing an uptick in number of cases as well as in Korea.
Thank you. So Candice, what happened with buyers and sellers in your market and where do you see it headed?
Well, certainly looking between 2019 with the end of the excise tax, or I should say the advent of the new excise tax structure in January of 2020, we expected a little bit of a hangover effect already in 2020. We ended up seeing, this is a little tough to hear, but about a 70 to 90% drop in volume in 2020. So that was what happened kind of at the early end. And, you know, just the same that everyone's, I think there was just sort of a market freeze where, you know, establishing value was really challenging. Now, what I feel like we're seeing now is we've had enough post-pandemic transactions that we have a little bit more clarity around where the market is. that's allowing buyers to feel more comfortable writing offers and getting into the market. And so, you know, that's a great sign. The piece that's still the unknown is sort of how does this eviction ban piece burn off, and what does that look like, and when, you know, the question of when do rents really start increasing again. And again, that's thunder for later, but that's the biggest question sort of in the minds of buyers right now. You know, and so it's really interesting to watch that sentiment and around investors and their mindsets. And it's very fickle when it comes to the news and what's going on. So thankfully now we have the chop and the chaz fully behind us. You know, Seattle for a while last year just had this like, what's going on out there? Institutional investors were concerned. People were pulling back from this market, and that's now enough in the rear view. We're not hearing that as much anymore. So that's allowing buyers to come back into the market. And, you know, I've done a little bit of projecting forward. And again, I think it's looking, you know, not a 2019 year, but certainly much, much better than last year. So that's encouraging.
So Seattle's kind of taken some hits over the last year with the politics, homelessness, riots, and all that. Has that simmered down? Yeah. Has that impacted Seattle's image in the world in terms of investments, or do things still pretty strong?
I think, you know, you make a good point. There's a lot of local sentimentality around sort of that black eye that we got last year. You know, if I look at the data and I look at kind of what's happening with values, you know, so we talk about volume, that's telling us are people contracting. The other piece is where are values? And, you know, they definitely took a dip when you look at price per unit and price per square foot last year. But we're actually seeing it recover, and it's actually over, and it might be because of some larger and newer transactions. But as we look at price per unit, price per square foot, it dipped in 2020 and it's coming back up in 2021. And this kind of shocks people when I say it, but our cap rates have either stayed the same or actually gone down. And there's kind of two reasons for this. One is we've had an impact on operations. So just to have the very same cap rate that you had before, your NOI has probably dropped a little bit, whether you're giving concessions or you're offering rent credits or something like that. The NOIs have been dropping, but the fundamental perception of investment value of this market is still positive, in my opinion. And also, you know, as we see these tech companies like Kelly was talking about, as we see that return to work, we're already seeing the fundamentals improving, right? Vacancy rates dropping, things like that. So we really feel very bullish, our team, on the future of Seattle. We have a lot of headwinds from a legislation standpoint, no doubt about it. But at least we feel good about the jobs and the opportunity here, and that's going to overshadow sort of the current legislative environment, we feel.
Thank you, Candice.
Yeah.
Kelly, how about the office market for buyers and sellers? What has happened, and what do you think is going to happen?
You bet. Well, I think that there's been a lot of thinking about what the future holds, and there's a lot of investors out there who feel that this area is the future is very bright. So while office has taken, it's tough right now. People are trying to figure out, what does the new office look like? How much square feet are they going to get? Or how much square feet are they going to need? Maybe they don't need as much square footage. That being said, the investment market, the values, they have not dropped. Now the sales volume has dropped, but you know, cap rates haven't softened. You've got institutional investors, they're picking up 4 to 5 star assets. The average yield in the Puget Sound is around 5.2%. Life science properties have been dominating the attention of institutional investors. As an example, the Bourne office lofts in the Denny Triangle area, that was sold for 885 square footage for about $119 million. In Bothell, the Highlands Campus Tech Center was sold for $53 million. And just in March of this year, Alexandria Real Estate paid about $45 million or 313 square feet for the Canyon Park Heights Office Center in Bellevue. So non-biotech deals have also closed, particularly on the east side as well. So you've got Talon and PGIM Real Estate. They paid about $169 million for the Microsoft leased Advanta Office Commons on I-90, and Microsoft has a couple of years left on that lease. So the average pricing stands about $480 a square foot, with 4 to 5 star properties averaging about 640 per square foot. And Seattle is still, people are still banking on the city of Seattle. It's got a ways to go with regards to recovery, but one of the largest sales in Seattle's history closed at the beginning of the second quarter of 2021. New York-based KKR and Seattle-based Urban Renaissance Group, they teamed up and they acquired 300 Pine, which is our former Macy's, and that's been converted to, as we know, the Amazon office. So that 770 square foot property sold for $580 million or $753 a square foot at a 4.3% cap in just last month. The new owners are going to renovate the ground floor, that retail portion, to attract the high-end tenants to downtown core. So while there's a lot of challenges right now, the future will be bright again.
Thank you very much, Kelly. So in terms of rents, what direction, Matt, what direction are rents headed in the industrial world?
Up. They have been heading up, and they are continuing to head up. I mean, and really it comes down to the fundamental of vacancy. We still have an incredibly low vacancy rate here in the Puget Sound, probably about 4 to 5% on average, and then that's going to, of course, skew and vary a little bit depending on size and submarket. But bottom line is most landlords are happy. Their buildings are staying full. They were able to keep the majority of their industrial tenants in their space in some way, shape, or form through the pandemic, and seemingly can see the light at the end of the tunnel now of getting through this. And so consequently, they're looking ahead and going, wow, I mean, there's still runway here. We can still have rental growth. Commodity costs are going up, which is going to get passed back to consumers. So these companies are going to be charging more and consequently can afford to pay more rent. So we've been continuing to see rent grow. I mean, it seems like every comp that I look at on a new lease deal is higher than the previous one I've seen. And that's just about, again, with our market being so institutionally driven, that is consequently their goal, is to do every new lease that they sign higher than the last one that they did. And even in talking with a few of them, I mean, they're basically taking the attitude of, hey, Matt, my entire portfolio is 97% full. I'm talking to the highest of high ups in our corporate, and they want our vacancy to be 10%, because if it's only 4%, that means we're giving everybody too good of a deal and they're willing to sign. So that means we just need to keep driving the rents up. I mean, it sounds insane when you think about it that way, but they're not wrong. I mean, somebody, generally speaking, is usually out there willing to pay for it. And it's a consequence of, again, just this e-commerce growth. So many businesses in the industrial sector seem to be doing really well right now and consequently can afford to pay that price. So it seems like that's only going to continue. Another thing, Fred, I know we were talking about it, was we're also seeing historically our market has had 3% annual increases in rent. That is changing as well. I think we're very quickly approaching 3.5% to 4% annual increases becoming the norm. And mostly that is a driver due to historical rent growth. I mean, if you look at CBRE put out a study at the beginning of Q1 of this year, and they are projecting for the Seattle market specifically, we're the #6 market in the country for projected rent growth over the next 5 years. So from Q4 2020 through Q4 2025, they're predicting 31.5% rent growth in the industrial sector in the Puget Sound. So you blend that out, that's well more than the standard lease of 3% annual increases. So landlords are thinking, A, we need to raise our annual increases to keep up with the projections, and B, we actually are starting to prefer probably shorter term leases, call it 3 to 5 years versus 7 to 10 years. 7 to 10 years used to be kind of the golden goose of leases, but 3 to 5 is becoming a little bit more preferable on the landlord side because they're thinking 3 to 5 years from now, they can just jack that rent up on their tenants another, call it 20, 30%, whatever it may be, right, from what they were paying when they signed that lease 3 to 5 years ago. So it's continuing to head up. Tough time for tenants.
So are you seeing any tenants that are getting squeezed out of the market or can't quite pay these rents or compete to get these spaces?
Yes, the simple answer to that is migration. I mean, the majority, if you look at the Western Washington, Puget Sound region, I mean, historically rents close into Seattle have been the highest. And as you move south along the I-5 corridor and head into some of those tertiary markets, land is cheaper and consequently building and construction costs are cheaper, and developers and landlords can afford to collect lower rents and still get their returns. So tenants who have been operating further north and paying top dollar rents in order to save money when their lease comes up for expiration, they're moving south. That's been a trend that's been going on for years. Now, what's quickly becoming an issue is the south, call it the south end rents, Pierce and Thurston County primarily, are starting to very quickly catch up with King County rents. And so there really isn't a big disparity anymore. I mean, it's still there, don't get me wrong, there's savings to be found, but it's becoming much harder to find those said savings. So most tenants, I think, are finding some way to figure it out, but there are tenants leaving the market, going to lower cost markets where there's more abundance of land. I mean, we're talking, the Dallases of the world, a lot of areas in Texas, Phoenix. There's been a huge industrial boom in Phoenix, and that's been going on for a while. And I mean, land and rent is just a lot cheaper down there, so people are moving.
Great, thank you, Matt. That's very informative. Larry, how are rents going in retail and restaurants?
Well, we all kind of expected rent to go down as a result of COVID. But what we actually saw were creative rent concessions from landlords to help retailers tide through the crisis. So it's more of a temporary mode. We have languages written in addendums and in leases that the rent concession will end and the rent rate will go back to normal when the COVID is over. We do see some lower rents in some segments of the market where landlords struggle to fill empty spaces, or when tenants use the COVID as an effective bargaining chip. But with this year, with light supposedly at the end of the tunnel, we are seeing a lot of resistance from landlords to go back to crisis rent of last year. And in fact, the mindset this year is what COVID, we are going back to normal.
Great, thank you, Larry. Candice, how are rents going in the apartment world?
Let's see, that's a good story. So we basically last year, we had this sucking sound in downtown Seattle where people found that they were going to be working from home. Everything was closed downtown. And so you had this sort of flight to the suburbs and outer lying markets. Interestingly, the feeling is that people left Seattle altogether, but actually they just generally moved within the MSA. So they're still here. That's good to know. There's certain tech folks that maybe moved to Bend because they can be remote forever. But coming back to the rent story, so what we saw was rents basically come down significantly over the last, call it 6 months to find the new bottom. And then what we saw was the addition of concessions in the market. First it started there weren't really many concessions being offered at all, except for maybe new building lease up. And the market overall went to, call it 1, 2, 3 months free. And that I've actually heard that that's the same in other urban cores like Chicago. I talked to someone in Chicago yesterday, and that was exactly kind of where they were as well on newer product. And so what we're seeing now, which is really encouraging, is a drop in the vacancy rates. And so we had You know, basically before the pandemic, we were about, for Seattle, 3.9%, which is quite healthy. It bumped up to about 7.5% and then back down to 5.5% right now, which is pretty close to equilibrium, really. And the reason for that is, you know, there was that reset, and now that, you know, basically that we're burning off some of that vacancy as we found the bottom. So from that standpoint, that's what's going on the vacancy side. And then for rents, you know, the question is sort of, when do we start to see some sort of rent growth? Our problem is we still have a lot of development that's in the pipe and got slowed down by the pandemic. So this year alone, we still have like 14,000 new units in this region coming online. That's not great. It drops to about 5,000 next year, about 4,000 next year. And then after that, it's like a cliff. There's nothing new after that. So our expectation is, you know, sort of stabilization this year. Initially, we thought 2023 would be the year for to start to see rent increases, but I actually think we might see them next year as we get that return to work and people reconfiguring already right now for that return to work in the fall. And so it'll be interesting to see how it really plays out, but indications are it's going to get better quicker than we were expecting.
Thank you, Candice. Kelly, in terms of office, what has happened with vacancy rates, rents, sublease, and do you see any permanent impact to office based on the pandemic and work from home?
Well, excellent question. And the answers really depend upon the area that you're talking about, because the city of Seattle has been hit the hardest with office. They've had a negative rent growth of about negative 6%. In addition, the vacancy has risen. Overall, we're about 9.5% vacant. Now, if you talk about subleasing and the subleases out there, well, we've got 6.8 million square feet of sublease space on the market. That's highest that it's ever been. So companies, not just the small or mid-sized companies, are putting their space up on the market, but Dropbox, for example, they put about 120,000 square feet of their space for sublease, which is in their brand new 2NU in downtown Seattle. Symetra in Bellevue CBD put about 135,000 square feet available. So there's a lot of sublease space on the market, and you can get some great deals with that. So rents have been affected, but again, it really depends upon where it is that you're talking about. Downtown Seattle has had that negative rent growth. Bellevue CBD has not had negative rent growth. Their rent growth has been more about 1.4% of rent growth. Then in addition to the changing, what does the future of work look like? Then you've got all the new construction, and the East Side is again fortunate. Bellevue and Redmond's new construction is already pre-leased. Seattle's not that way. So that'll continue to affect the rents as we move forward, as well as finally trying to absorb all of that sublease space that's been put on the market. Now, the Spring District and Pioneer Square, you can get about a roughly 10% discount in rent to Seattle CBD, and as well as Lake Union. So it's really about, what does the future of work look like? We've heard a lot about having nodes in different areas and having locations where the team members live as well. So an example is REI coming to Issaquah here. Their team members, they have a lot of team members in this area who live here. Now they don't have to commute. So it's about getting them quality of life. And I think you're going to see more of that in these areas and more in the tertiary areas, and particularly the East Side. So the East Side will recover faster than Seattle office.
Thank you, Kelly. Appreciate that. Guess we'll go back to Matt. But Matt, do you see any lasting changes from COVID and going forward? Things that people have done, things that are different?
I think the biggest change is just the change in consumer expectations. And again, I'm going to bring up e-commerce again, and I hate to do it, but it is the biggest driver here. And so as e-commerce continues to grow and become such a larger segment of consumer spending and overall goods going out to homes, it's continuing to drive the need for warehouse growth. I think a stat, this is an old one that I heard, but I think for every $1 billion of sales, about 1 million square feet of warehouse space is needed to support that. And so spending is continuing to go up on that in the e-commerce segment. And consequently, as consumers, especially the younger generations, I mean, their expectation of ordering a good and showing up to the house is that it was supposed to show up yesterday when you ordered it today. And so last mile is becoming ever more important, and institutional investors are seeing that, and they're willing to pay more for sometimes even call it obsolete product or product that needs high investment to get it up to snuff and comparable to Class A new product, as long as it's well located, and they will spend top dollar to do that. A great example is Bridge Industrial. They actually just purchased a warehouse in South Seattle that has very shallow truck courts, lower clear height, had a lot of deferred maintenance, but they have a value add fund, and they're purchasing that, and they're going to dump a ton of money into it and advertise it as a last mile hub to Seattle and hit probably a significant number of residents in that area. And so again, there's just more people pushing into that kind of growth and area in the market, and consequently the pandemic is again only accelerating the need for this supportive warehouse space for business operations. The only thing that we're probably seeing that is still up in the air is the manufacturing segment. I mean, we're given the two ports, we're such a distribution heavy market here in Western Washington, but we do have a pretty solid manufacturing presence. And for the longest time that was driven by aerospace, which we all know has been hit or miss, and mostly so been a struggling industry now for several years, even pre-pandemic. But there is a lot of talk. I mean, but before the switch in presidential administration too, a lot of onshoring coming back. A lot of manufacturers are still trying to figure out how to produce goods both in the U.S. and here in Seattle specifically. So it'll be interesting to see how that continues to affect those spaces, because there is such a higher demand for distribution space. But all things considered, it seems like despite pandemic and effects, where everything is still continuing to head in the direction that it was heading pre-pandemic.
Thank you. Larry, in terms of retail, how did the pandemic impact things? And do you think anything's going to keep going, like takeout orders for food? And do you think retail is going to continue to struggle with more online? It seems like online got accelerated. But what do you see the future for those two products?
Well, I think delivery service will continue to be stay. Of course, that's a general statement, because there's some of us who are so eager to go out to restaurants, and to be together and, to meet up face to face. But in general, I think the people are getting used to ordering something online and having food delivered to their house. So that this should stay to a certain degree. Drive-throughs are very much sought after right now. A lot of shopping centers, they're having pet buildings, drive-throughs, Starbucks, even Panda Express, they're having drive-throughs. They're experimenting with drive-throughs. So that is something extraordinary, and I think that is something that will stay. And in the last 1 year, we are so used to Zooms. We even have medical appointments that are virtual, and notaries closing. We can have virtual notary. So I think to a certain degree, this should stay.
Great, thank you. I think we'll go back to our chat here and just maybe ask Candice this one. Of the 4 property types, have there been any noticeable financing hurdles? So in apartments, what's happened with financing?
Good question. That's been a little bit of the Wild West over the last year, in that just as investors are trying to make decisions with how to invest their dollars, the lenders, being even more conservative, are trying to make decisions on how they're going to allocate their dollars. And so What we're seeing is an increase in reserves required at closing, increased down payment amounts. So, you know, a debt coverage ratio in city Seattle tends to be a debt coverage ratio constrained market versus loan to value. That's just a subtlety that, you know, when you're out kind of out further from Seattle, it's usually a loan to value conversation. You know, maybe it's 25%, 30%, something like for the down payment. And in city Seattle tends to be more like 50% down for a lot of apartment buildings. And when those debt coverage ratios of usually it was like 1.15 and it ballooned up to kind of 1.2, 1.25. So you can see that's just crushing your loan amount. And so then the only way to put the deal together is, you know, have a big down payment buyer or you bring the price down, right? You have to bridge that gap. And so we saw that initial really big pullback and a raise of that debt coverage ratio requirement from lenders. It softened a little bit. I think we're probably floating around, you know, from that 1.25 kind of hammer to more like 1.2 and in some cases 1.15, depending on how well located. So, but the down payments are usually the big conversation because a lot of buildings that are turning over might have lower rents. And what we've seen this past year is with no ability to raise rents and your operating expenses continue to rise. I was talking about how the operations degraded, right? You had a year's worth of expenses tacked on to no increases on rents. So it's kind of a double whammy and it affects the loan amount. So then it affects how much you have to put down on the property. So that's some of what we're seeing on the multifamily side for financing. The bridge option, sorry, I almost wrapped up. The bridge is the new, because you've got really nice interest only options. You've got the ability to really get to that 30% down, and you're going to be putting in money into the property to improve it. The trick is when can you raise rents to kind of justify the whole project? So that's
Thank you. Very interesting.
About the bridge.
Boy, we're almost running out of time. That was a quick hour, but I'll end with Kelly and just ask you, how has politics affected your asset class? And then maybe you can touch on the cost of construction and what's that done to office buildings.
Sure. So politics has definitely been a factor, particularly in the city of Seattle, with unfortunately the riots and all of the challenges that both sides of the coins have with regards to that. Plus you add the fact that you don't have office workers there for the downtown retail. It's been a ghost town in the city of Seattle and with a 5% vacancy. In addition, you know, it's been some businesses have really pushed back with regards to having people in the office, but they're starting to feel better about that with the vaccine rollouts. And I think you're going to see a lot of changes happening in a fast manner. You would think that that tenants wouldn't want the common areas like they did before, but people are really about being able to be innovative and creative. And so as a result, just to give you an example, last week, the CEO of WeWork announced that they are seeing a bounce back, and that's faster than they expected. In fact, April was their best month since February 2020. They saw a double-digit growth in the last 60 markets. So if you can have flexibility, that's great. They were thinking that they weren't going to see people in their common area spaces, but that has not been the case. People want to be with people. And so that has been a paramount. Now, Fred, what was the last part of your question?
It's about construction costs.
Oh, okay. Yes. So the supply side for construction, even before the pandemic, construction prices, labor prices were just astronomical. And now you add in the pandemic, where the supply for whether it's steel, for whether it's wood products, etc., have been really difficult to, there was a shutdown of that. And so as a result, the supply is, it's not it's not there like it used to. And so the prices have gone through the roof. It's going to be really interesting to see how we move forward with the construction, because now that we have the supply of goods going up, well, interest rates, we've seen gas prices tick up a little bit. We're going to see them tick up even more in the fall. And interest rates always follow the uptick of interest rates always follow the uptick of gas prices. So you're going to see I believe you're going to see interest rates going up as we go into the fall. So that's going to be a really interesting thing to watch. But if you've got an asset, you've got value in that asset now. So that is key because it's built. And so I think you're going to see some inflation happening, and that'll be good for if you have current assets. But it's tough to swallow when you are building a new building.
Thank you very much. Well, that's all the time we have for today, but I'd really like to thank our panel. We did some preparation and looked up some statistics, and I think there's a lot of great information today. So that's all we have for today. Amy, do you want to add anything to that? Oh, Kelly, you're going to shut it down.
Yep, I'll go ahead and close this out here. So thank you, Fred, for moderating. Thank you, Candice, Matt, and Larry for being here today and providing such great information. We do have our Site to Do Business webinar, which will be on May 18th. Please check out our website. In addition, next month, mark your calendars for June 9th. That will feature Rob Sargent with Sargent Legal, who will be teaching us about how we can make money and how we can add value as a broker with title and escrow and what we don't know about it. So how we can add to our business. So I'd like to thank our speakers as well. Thank you to our attendees for attending today, and our sponsors. Please check out our website for more information about our committees. Get involved with us. We'd love to connect, and we'd love to have folks be a sponsor. So check out CCIM-WA.com for more information. And thank you, everybody. We'll see you in next month's webinar or on our next event. Have a great day.
Thank you.
Hello, everyone.